capital budgeting. Let's move ahead and talk about the next topic, which is weighted average cost of capital. So all this while we were discounting it using a discount rate. This discount rate is effectively the rate of return that the firm wants, or effectively the rate of return that the stakeholders of the firm want. So the same thing becomes effectively the cost of funds for the company. The return that you have to give to the stakeholders becomes cost of funds for the company. So effectively we find out something called weighted average cost of capital for the firm, which effectively is nothing but what is the average cost of capital weighted by the proportion of all the stakeholders in the company. Now who could be stakeholders? Equity holders could be stakeholders, debt holders could be stakeholders, preference shareholders could be stakeholders. Fine. So preference share is, for example, a share that gives us standard fixed dividend every year. That's preference shareholders. So we have to find the proportion or weights of each of these three. So we find E by V, we find D by V, and we find P by V, where E is equity value, D is debt value, P is preferred capital value, and V is the sum of the entire funds that the company has. So what is the proportion of equity, what is the proportion of debt, and what is the proportion of preference capital in a company's funds is effectively what is given by these terms. When we are looking at a weighted average cost for all of these, we are effectively talking about what is the cost of equity, what is the cost of debt, and what is the cost of preferred capital, preference shares. Once we have found these, we can effectively find out what is the weighted average cost of capital that the firm is raising. This is the minimum return a company would need. So effectively you will use this as discount rate for any projects that are using these funds. Now this obviously requires a few calculations. CE is the cost of equity. We will learn how to calculate that. CD is cost of debt. We will anyway learn how to calculate cost of debt in fixed income, which is happening tomorrow. For now, practical purposes, we will be given cost of debt in these kind of questions. But even if we have to calculate, it's a straightforward approach. We will learn that tomorrow. Cost of preference capital can also be calculated. We will learn how to calculate that as well. The cost of debt, remember, debt gives a tax break. So if the interest cost is 10%, you save the taxation on it. So effectively, the post-tax cost of debt becomes 10% into 1 minus T. Fine, so that's what comes out. The question that first comes to my mind is whether to use book values or market values for all these sources of funds, equity or debt. Should the value used be book value or should the value used be market value? Now most of us would believe that using book value would be more conservative. On the contrary, it is not. Book value is not conservative. Ideally, to be very, very certain, at this point of time, what is important is to understand that if a firm goes and raises capital today, they will raise it at this market value. If I'm issuing new stock in the market, it will come at the market value. If I'm issuing debt in the market, it will come at market value of debt and not at book value of debt. So market value is what is supposed to be used here. Even though it is volatile, remember that it is elastic. A book value only changes if you have a particular frequency that has passed in terms of time. So once a company comes with quarterly or half yearly results is when book values will change. It is usually difficult to incorporate book value changes in between. Market values of listed firms are available on a daily basis. So any news that comes out will immediately get incorporated in the market value, which makes them more elastic and more recent in terms of their knowledge and makes them more correct as well. If you want to use mathematics, you can calculate for a particular firm where market value is greater than book value, or market value equity is greater than book value of equity. You will find that using market value gives you more conservative numbers. It's not required to understand at this point of time, but broadly understand that in all these questions where you have been given book value and market value of equity, debt, etc., use market value. Fine. Now book value of debt is not very different or is almost similar to market value of debt. That's because interest rates don't change dramatically. Unless the firm's credit rating has changed dramatically, these can be taken in the place of each other. But in the case of book value of equity and market value of equity, surely you have to take market value of equity in this. Fine. Now let's move ahead to the components. So we have to calculate cost of equity, cost of debt, and cost of preferred capital. Correct? Let's understand this. So first, cost of debt is what we will look at. It can either be calculated using yield to maturity. So if a company issues a bond, what is the YTM of that bond? We will discuss this tomorrow in our fixed income bit, so we'll know it. Or we can use debt rating of companies, which means a AAA rated bond charges, let's say 8%, a AA rated bond charges 8.5, gives 8.5%, a A rated bond gives 9%. So if you have the debt rating of the company, let's say a new company we are evaluating that has a debt rating of A, we will use 9% as cost of debt. So even that could be given in the question. We can back calculate it to get this. Cost of debt usually is given. What is necessary is to understand. If it is not given, we can use YTM approach, which we will discuss in detail tomorrow any which ways. Debt rating is straightforward. You would be given the similar class of debt rating. Just pick up whatever is the debt rating of the firm and use it. What is cost of preferred stock? Now, preferred stock, typically, let's say this is a non-callable and perpetual. Fine, non-convertible, non-callable and perpetual, which means if you hold this stock, you will receive this dividend till infinity. So if the price of the stock is 200 and the return it gives is 5%, effectively you will receive 10 every year till infinity. Till the time you hold this stock, you will keep receiving this 10. So the formula is actually straightforward. 200 into whatever is the dividend is going to give you the dividend rate. So what we have done is effectively the dividend of preferred share divided by the rate that you require should give you the price of the preferred stock. Straightforward. 200 is equals to 10 by 5% effectively. That's what we are doing here. Correct? So that's the net formula. Now if you have to find out cost of preferred stock, which is this, all you need to do is rearrange this equation to give you this number. What is the dividend on the preferred stock every year divided by the price of the preference share in the market? That's all you have to do to find out cost of the preferred stock. Fine. That's cost of debt done, cost of preferred stock done. Next comes into the line cost of equity. How do we calculate cost of equity? Cost of equity can be calculated 2 or 3 ways. We will discuss 2 of them here. One is called expected return using the capital asset pricing model, where we have a risk-free rate, we have an equity risk premium, and we have a beta. Note what these 3 terms say. Risk-free rate gives you the risk-free rate in the economy. So if you invest in the government bonds of this country, you will make RF for sure. Equity risk premium gives you the excess returns one gets by investing in the stock market, which is effectively stock market returns minus risk-free rate, excess returns, right? Beta is the systematic risk of a particular asset within this market, within this stock market. So beta is the specific risk of a particular stock. Just to understand very simply, if beta of a stock is 1.1, that means if market moves 10, if the underlying stock market moves 10%, the stock will move 11%. If the underlying stock market moves minus 10%, the stock will move minus 11% in general. So that's what beta tells you. Higher the beta, riskier it is because volatility is more, moves are bigger. Lower the beta, safer the stock is considered. Fine. So you could calculate cost of equity using this. What is the expected return on that stock? You could use this formula to calculate it. We have also probably studied about dividend discount model, which effectively says that if there is a steady state growth that the firm has entered, then effectively the price of the stock can be found by next year's dividend divided by cost of equity minus the growth rate in dividends. This G is sustainable steady state growth. Obviously the assumption being G is less than R. That's the assumption that underlines this. Now in this equation, if we rearrange the items, remember dividend is for next year, it is not this year. So it is effectively this year's dividend multiplied by 1 plus G because we have a steady state growth rate and the firm will maintain its dividend payout ratio. Fine. What we do then is if we rearrange these items, it becomes D1 plus D1 by P, which is nothing but next year dividend yield plus the growth rate, that is sustainable or steady growth rate that is given. This should give me the cost of equity. So there are two ways of calculating cost of equity. Either I take next year dividend yield and add sustainable growth rate to that, or I take risk-free rate and add beta into risk premium to that. Fine. Now obviously if I use the second one, that's straightforward, but if I use this first one, it will get me into two more tussles of finding the beta and finding the risk premium. How do we calculate beta? Beta, as I said, very simply is the number of times of the returns the stock will show you as compared to the market. Very simply put, the calculation formula of the beta is covariance between asset and the market by variance of the market. Usually we are given beta in the questions, usually. What could happen, however, is there could be a firm that is, for example, let's say unlisted. If it is unlisted, you cannot find beta using variance and covariance because you have no stock price data for it. So you cannot find returns and regress the returns to find out covariance or variance of those returns effectively, correct? So in this case, you have to use a comparable firm's beta, and that approach calls for creating something called levering and unlevering beta. Creating levered and unlevered betas. I will come to this topic in a little bit of time. Give me a couple of minutes and then we will discuss this topic. The formula for levering and unlevering I will discuss in a moment. So don't worry about this. I'll just leave it for a moment. Risk premium, which is RM minus RF, could either be given to you or you could be given historical stock returns and risk-free rates and you can take the difference and find it out. Alternatively, what could happen now historically, the problem with, let's say, a country like India and the stock market is that the stock market is practically about 20 years old. So you do not have enough data to actually confidently find out this number. In this case, what you find out is effectively what is the bond spread of the country. The risk premium effectively is the bond spread of the country plus the ratio of volatility of the country's stock markets to volatility of the country's bond markets. So effectively what we are talking about is saying that, let's say, US equity risk premium is 5%. Some other country's bond yield is something like 7%. So this spread talks about the risk of investing in this country's bonds. If I have to scale this risk to the risk of investing in this country's equity, effectively I have to multiply it with these numbers. This should be multiplication. This is incorrectly marked as plus. This should be multiplication. I will multiply with the ratio of these two terms. Fine. So that's how I will find risk premium. Let's actually try and solve a detailed question which will solve all these. So what we have discussed so far will solve all of that. So let's look at that. First, let's calculate the first and simplest concept on weighted average cost of capital, which is basically we have been given the ratio of debt, we have been given the ratio of preference capital and equity in the total capital. We have to calculate WACC, Let's first, we have been given current yield on bonds, which is the interest rate effectively for the firm. Stock beta is given to us, risk-free rate, market risk premium is given to us, preference dividend is given to us, preference stock price is given to us, and tax rate is given to us. So let's first calculate after-tax cost of debt. This is CD multiplied by 1 minus the marginal tax rate. So that's 7.7%. Let's calculate cost of preferred stock. Remember, it is perpetual dividend divided by the preference stock price. So that gives me 8%. Just divide the dividend by the stock price and you'll get it. Cost of equity is to be calculated using RF plus beta into RM minus RF. RM minus RF is given as 5%, beta is given as 1.2, RF is given as 10%, let's say. Let's try and calculate for this. So effectively, when we are saying this, we find cost of equity equal to risk-free rate plus beta into risk premium. I get that as 16%. Now all I need to do is do a simple weighted average that I need to calculate. So debt 40% multiplied by 7.7% plus preferred 20% multiplied by 8% plus equity 40% multiplied by cost of equity, which is 16%. Weighted average cost of capital for this firm is 11%. That's one kind of question that you can get. Fine, usually. Now what we'll do next is, if